4 types of Forex trend indicators. Many Forex traders spend their time looking for that perfect moment to enter the markets or a telltale sign that screams buy or sell. And while the search can be fascinating, the result is always the same. The truth is, there is no one way to trade the Forex markets. As a result, traders must learn that there are a variety of indicators that can help to determine the best time to buy or sell a Forex cross rate. Here are 4 different market indicators that most successful Forex traders rely upon. Indicator number 1. A trend following tool. It is possible to make money using a counter-trend approach to trading. However, for most traders, the easier approach is to recognize the direction of the major trend and attempt to profit by trading in the trend's direction. This is where trend following tools come into play. Many people try to use them as a separate trading system, and while this is possible, the real purpose of a trend following tool is to suggest whether you should be looking to enter a long position or a short position. So let's consider one of the simplest trend following methods, the moving average crossover. A simple moving average represents the average closing price over a certain number of days. To elaborate, let's look at 2 simple examples, one long term, one shorter term. Now, let's set up in our chart the simple moving average as our trend following tool. We will use the 50-day and 200-day moving average crossover for the euro and US dollar cross. The theory here is that the trend is favorable when the 50-day moving average is above the 200-day average and unfavorable when the 50-day is below the 200-day. As the chart shows, this combination does a good job of identifying the major trend of the market at least most of the time. However, no matter what moving average combination you choose to use, there will be whipsaws. You can change anytime the values like 10-day and 30-day moving averages cross over. The advantage of this combination is that it will react more quickly to changes in price trends than the previous pair. The disadvantage is that it will also be more susceptible to whipsaws than the longer-term 50-day and 200-day crossover. Many investors will proclaim a particular combination to be the best, but the reality is, there is no best moving average combination. In the end, Forex traders will benefit most by deciding what combination, or combinations, fits best with their time frames. From there, the trend as shown by these indicators should be used to tell traders if they should trade long or trade short. It should not be relied on to time entries and exits. Indicator number 2. A trend confirmation tool. Now we have a trend following tool to tell us whether the major trend of a given currency pair is up or down. But how reliable is that indicator? As mentioned earlier, trend following tools are prone to being whipsawed. So it would be nice to have a way to gauge whether the current trend following indicator is correct or not. For this, we will employ a trend confirmation tool. Much like a trend following tool, a trend confirmation tool may or may not be intended to generate specific buy and sell signals. Instead, we are looking to see if the trend following tool and the trend confirmation tool agree. In essence, if both the trend following tool and the trend confirmation tool are bullish, then a trader can more confidently consider taking a long trade in the currency pair in question. Likewise, if both are bearish, then the trader can focus on finding an opportunity to sell short the pair in question. One of the most popular and useful trend confirmation tools is known as the Moving Average Convergence Divergence, MACD. This indicator first measures the difference between 2 exponentially smoothed moving averages. This difference is then smoothed and compared to a moving average of its own. When the current smoothed average is above its own moving average, then the histogram is positive and an uptrend is confirmed. On the flip side, when the current smoothed average is below its moving average, then the histogram is negative and a downtrend is confirmed. In essence, when the trend following moving average combination is bearish, short-term average below long-term average, and the MACD histogram is negative, then we have a confirmed downtrend. When both are positive, then we have a confirmed uptrend. Indicator number 3. An overbought or oversold tool. After opting to follow the direction of the major trend, a trader must decide whether they are more comfortable jumping in as soon as a clear trend is established or after a pullback occurs. In other words, if the trend is determined to be bullish, the choice becomes whether to buy into strength or buy into weakness. If you decide to get in as quickly as possible, you can consider entering a trade as soon as an uptrend or downtrend is confirmed. On the other hand, you could wait for a pullback within the larger overall primary trend in the hope that this offers a lower risk opportunity. For this, a trader will rely on an overbought or oversold indicator. There are many indicators that can fit this bill. However, one that is useful from a trading standpoint is the 10-day Relative Strength Index, or 10-day RSI for short. This indicator calculates the cumulative sum of up days and down days over the window period and calculates a value that can range from 0 to 100. If all of the price action is to the upside, the indicator will approach 100, if all of the price action is to the downside, then the indicator will approach 0. A reading of 50 is considered neutral. In our chart displays the 3-day RSI for the Euro and US dollar cross. Generally speaking, a trader looking to enter on pullbacks would consider going long if the 50-day moving average is above the 200-day and the 3-day RSI drops below a certain trigger level, such as 20, which would indicate an oversold position. Conversely, the trader might consider entering a short position if the 50-day is below the 200-day and the 3-day RSI rises above a certain level, such as 80, which would indicate an overbought position. Different traders may prefer using different trigger levels. Indicator number 4. A profit-taking tool. The last type of indicator that a Forex trader needs is something to help determine when to take a profit on a winning trade. Here, too, there are many choices available. In fact, the 3-day RSI can also fit into this category. In other words, a trader holding a long position might consider taking some profits if the 3-day RSI rises to a high level of 80 or more. Conversely, a trader holding a short position might consider taking some profit if the 3-day RSI declines to a low level, such as 20 or less. Another useful profit-taking tool is a popular indicator known as Bollinger Bands. This tool takes the standard deviation of price data changes over a period, and then adds and subtracts it from the average closing price over that same time frame, to create trading bands. While many traders attempt to use Bollinger Bands to time the entry of trades, they may be even more useful as a profit-taking tool. In our chart displays the Euro/Yen cross with 20-day Bollinger Bands overlaying the daily price data. A trader holding a long position might consider taking some profits if the price reaches the upper band, and a trader holding a short position might consider taking some profits if the price reaches the lower band. The bottom line: if you are hesitant to get into the Forex market and are waiting for an obvious entry point, you may find yourself sitting on the sidelines for a long while. By learning a variety of Forex indicators, you can determine suitable strategies for choosing profitable times to back a given currency pair. Also, continued monitoring of these indicators will give strong signals that can point you toward a buy or sell signal. As with any investment, strong analysis will minimize potential risks.